Awesome. Hi, everyone. Allon. I started my real estate investment firm 6 years ago when I was a student at Hofstra. Started with houses and borrowing hard money at the time. Knew nothing about the accounting space, what cost segregation even was, any of that good jazz. Just tried to make something so I didn't have to get a job when I got out of college. Almost went for accounting, actually.
And so we could pick on Chris a little later. He does have a minor in accounting, so he decided not to take the fun route and join us, but we can make fun of him later, no problem.
So one house with hard money led into 5 houses. 5 houses led to 60 houses, primarily in Long Island. And over time, I learned how to raise money, pivoted into some syndications. I have a fund and bought industrial, retail, mixed-use buildings, and multifamily in and out of state. Now we're hovering around $120 million in AUM, and we're still a small shop. We try and retain as much equity as possible, and the world has completely shifted for us recently. Everything's gotten a little bit crazy lately. So we're pumping the foot on the brakes a little bit, stabilizing the portfolio, and trying to stay strong.
So you mentioned a point that I actually wanted to bring up. So looking at your website, sometimes you might not be able to tell where some of the funding comes from, right? Because you say you try to maintain as much equity as you possibly can in-house, right? So maybe giving an idea of some of the perspective of, where does some of the capital come from, some of the trends you're seeing in the market in which you're going to actually flow some of that money to. I think that might give a little bit of an insight to some behind the curtain, if you don't mind.
Yeah. When I started the business, I didn't know about raising money. So I was just trying to buy properties, right, and build a portfolio. My initial thought was if this property can make me $2,500 a month, then I need to do 2 of these, and my lifestyle's not that expensive, so I don't really need to go out and work for someone else. So I did that. I kept doing that, and then I realized there was a much bigger picture. What I recognized was that these syndicators, which you guys are all accountants, right? So you probably work with a ton of syndicators, and a syndicator goes out, raises money from 100 different people. They do a 20 plus 2, let's say. 20% of the upside, 20% promote, 2% in fees. And that syndication, that GP, that syndicator, typically gets dwindled down. It gets diluted to like 5% equity in the property. And I recognized early on, I didn't want to be that guy. I want to retain as much equity as possible. So I went through a different structure, a joint venture structure, where we would take no fees up front. So we had to work on really slim margins. We would take no fees. We were driven by the performance of the property, and we'd be very picky with the properties, which led to building a big deal sourcing team. The deal sourcing team is really our bread and butter. It's really what gave us our competitive advantage in the space and let us identify these unique opportunities across the country. Once we realize upside, then we bring back the money back home. Right now, where's our money flowing? Medical office, industrial, and we're trying to stay in supply-constrained markets with assets that have high demand.
Interesting. So I think because we're all here in New York, right? So some of the things that we focus on are not just here in New York, but outside. But I think to drive some of the focus back into the New York market, give us a little bit of the insight of what, even though we hear about what some of the large players are doing, right? What have you learned from them that you've been able to implement, not just maybe so recently, but some of the things that you've implemented from beginning to now? Things that maybe we are seeing every day that you want to throw some emphasis on, or some things that maybe we haven't really seen because we're face down in the books, right, so to speak.
I know my answer. I want to hear what the Director of Investments has to say.
Yeah, no, please, so Chris.
Well, nice to meet everyone. So as Tyler and Allon introduced me, I'm the Director of Investments at Avgi, so my primary role is working with new and existing investors on onboarding them, underwriting properties, and doing the due diligence when we're under contract, and creating the business plan. So with that being said, a lot of the deals that we're underwriting and seeing a lot of, and kind of going off of what Allon is saying, is stuff that's really in supply-constrained, high-demand markets. And so what better market for that than Long Island, where it's very difficult to build new supply and build new properties. So what we've been seeing a lot of is a lot of industrial properties have had extreme rent increases year over year, where the natural rent, when we were buying properties 2 or 3 years ago, you were seeing maybe $12 a foot, $13 a foot. Those same properties 3 years later are now renting at $18 to $20 a foot. So you're seeing massive upside in these industrial properties, and it's because there's so much demand and need for these businesses to have either distribution and that last mile delivery to be able to deliver to people in the current day and age with e-commerce. But then I think it's also just you have a lot of businesses that need storage and distribution to greater markets, commercial markets, whether it's delivering food to grocery stores, or major government equipment to different areas of the New York State government. And so there's a lot of different uses for industrial that a lot of people don't realize. They instantly just kind of think e-commerce and storage, but because there's so much use and not a lot of supply, I think that's why we've been seeing a lot of
What do you learn from the big players?
And what do I learn from the big players? That exact thesis. So we're seeing a lot of major players right now in our space that are typically targeting much higher deal sizes on a specific basis, where it's 15 to 50 million and up, and we're more in the $3 to $10 million range on a single property. And they're kind of following a similar strategy of of finding these sorts of properties where there's a lot of demand and not a lot of supply. And maybe you're overpaying at the beginning, but because of the fundamentals of the market, you're seeing a much stronger return naturally over time. So I would say that's probably what we're seeing.
Can I ask a question? So Long Island is famous for NIMBYism, right? I'm sure you guys, does everyone know what that is?
I didn't hear you. For what?
Long Island is famous for its NIMBYism, which is not in my backyard.
Yep,
So
yep.
when you're looking at this industrial, is it any of the are you refitting or repurposing existing and you're dealing with zoning? Or are you really just taking something now and sort of buying that existing building and using it for that same purpose?
So we're staying with the same use. The NIMBYism, you touched on a great point, because early in my career, I started opening homeless shelters.
Oh God, Long Island must have been crazy for that.
You want to talk about NIMBYism?
Yeah.
You have no idea. I was getting warrants for my arrest. I'm like, what did I do? I didn't even do anything.
Long Island.
But everybody knows somebody in Long Island. Everybody has a unique friend. And it was so funny. It's like you realize over time, like it's not all about just money. Like the money comes, money goes, and in business, if you have the right model, you could scale infinitely, right? But some things just aren't worth the headache. So I was doing phenomenally well with these shelters, these sober homes, these houses that people needed, and the state was paying absorbent amounts of money for.
Yeah.
But the side effects of that just could destroy you, and it was totally not worth it. But yes, that's touching on NIMBYism. Talk about ESG, right? Like that is the definition of ESG.
Right.
But Long Island, it's like, good luck. There's a lot of Italians too. You don't want to rub them the wrong way. Now,
Personal offense, Long Island Italian.
now wait, you asked about the giants, right? Like, what do we take from them?
Yeah, for sure. So if you can implement that in what kind of market, and give me some insight.
I'll tell you two things I learned from the giants of this space. Starting from zero. I started with 40 grand, very humble beginnings. My parents had a furniture store, so I really built this up on hard work.
Right.
And I always looked up to people. I looked up to a couple city giants, right? I'm like, these guys, they're incredible, the ones that were self-made. A lot of it is nepotism driven, right? A lot of the families, the generations. I'll tell you two things. One, they're liars, a lot of them. A lot of them are compulsive liars. They're pushing an agenda. So you can't believe everything they say. You want to because they're giants and it's incredible what they've done. But we touched on this earlier. So one of them pushes the office space. Office. Are any of you going to buy classy office space in New York City? Yeah. So it's a sensitive subject, so we won't dive into it too much. But I mean, running at 40 to 60% vacancy, I wouldn't put my money in New York City classy office unless there was a repositioning play. Some of them push that because that's their agenda to get people back to work from home. And that's great, right? That makes sense. Two, some of them have foresight, but it's fundamental foresight. It's the basics. Just like anything else. I was a wrestler in high school, and my coaches kept drilling into our head, just a double leg, do the basic double leg. And I'm like, no, I want to do backflips. I want to be cool. And they're like, you're going to be cool when you win. So winning is sticking to the fundamentals most of the time. The fundamentals are stay away from bad debt. Stay away from bad debt. You hear me?
Stay away from bad debt. I heard you.
Bad debt is scary and time sensitive, and when the economy turns the way it is right now, all you're going to scramble to do is get away from that bad debt. And residential will never go away. Kind of basic.
Two pretty strong building blocks, I guess, if you're in the Avgi portfolio of things and looking to build that way. You did mention debt. You mentioned a few things on finance. So talk, I don't know if you can at some extent, some of what you're seeing in the market in terms of the finance side of things, right? Some of these rates, like where do you think they're moving? How have you been able to combat? Listen, I think we all understand where rates are right now and where they used to be, probably in comparison to when you started and up to today's date. Give us like a little bit of a snippet of now and where things could go and some of the climate of the market on that.
Yeah. Debt has evaporated from the market. We're a small shop. We're very young and ambitious. So we've rode the wave like all the way to the end, as far as I feel. When everyone was saying slow down, stop buying, debt is skyrocketing, we knew that, but we have a big deal sourcing operation. So we look at about 200 to 300 deals every single day. That's been like the framework of our business, buying these unique opportunities in whatever market we're in. We've constantly bought as long as the debt has been made available, whether it was 4% or 8%. As long as it's made available and we have a 5-year run that we can basically execute our business plan on, then we're comfortable with the debt. Almost every lender that we have borrowed from in the last 6 years, and we've done $300 million in transactional volume, about 100 properties. So we're very active in the smaller deal side, but we get experience, right? We're touching these deals every day. We feel it from every angle. Deals have become much more abundant. There's a ton of them. And the debt has evaporated, specifically over the last 3 weeks. Many people will say, oh, the rates have been going up, it doesn't make sense. Not making sense and debt being available are two completely different things. If the lenders are lending to you and you have a business plan you could execute on, then maybe it makes sense to you, right? Maybe it makes sense to Rise 48, maybe it makes sense to Cardone, maybe it makes sense to Reckler, to all those guys. You don't decide that, I don't decide that. Only the buyer decides that, right? And if the debt's available, you can buy. The debt has evaporated, and now we're pumping our foot on the brakes. I feel like we've ridden that wave all the way to the end. As of 3 weeks ago, our office has said pens down, no more buying. No matter how good the opportunity is, we don't want to see it. So what I think is going to happen, educated guess. I wasn't around for the '08 ride. Some of you guys probably were, so you've seen things that I haven't. But what I think is going to happen is seller financing is going to become much more common. We're going to see it regularly at much better terms. And we're going to have an influx of deals that we haven't seen over the last decade.
Awesome. All right, cool. I think we spoke quite a bit on some of the finance. So if anybody, I just wanted to pause for a second, of course, if anybody had questions on that. I mean, I'm going to leave some time open for Allon towards the end of the conversation as well. But if anybody had something a little bit more hot, Lisa.
Could we stick with financing for a minute, since interest rates are what everybody's talking about, and regional banks? So when you're looking to your bank relationships, and it's all about the story you tell in the relationships, are you finding regional bank relationships? Are you going with the larger ones? And is it true that it's really about the story you're telling when you're sitting with the bankers and having those relationships going forward?
You want to answer?
Sure. Yeah, so I think the best way to answer that question is to quantify actually what we've seen in the past few weeks. So we just put a property under contract that this was about a month ago. 9 times out of 10 over the past 3 years, we'd be able to get 5 or 6 term sheets from our different banking relationships. We can hassle a little bit on the rate and terms, and then we can pick one and move forward.
Yeah.
We went to 32 banks on that deal, and only 1 bank came back with a term sheet. On
Who?
32 banks. It
was
actually a Texas bank lending on a New York property that we had a relationship with.
Yeah.
From owning properties in Texas.
And what was your LTV on that?
65%.
Really?
But it was 65%, but it was 8.75% interest. And I would even say a year ago, it would have been 5.5.
Yeah.
So the market has changed dramatically with our
relationship.
relationship.
And your math still works at 8.75.
Yeah, I mean, to an extent, we buy distress. Mm-hmm. So we're value creators. We don't buy stabilized deals. So yes, our deals almost always pencil. When I started, I was borrowing at 14% debt, and it made sense. Yeah. The way I began raising money was the guys lending me at 14% were like, how are you still making money, you psychotic kid? Like you were lending to you at 14%, they're making money hand over fist, right. And I'm still doing great, and I get to own the assets, refinancing out at 4%. So that wave was phenomenal. and I think we hit the timing perfect. But yeah, regional lenders primarily,
Yep.
private money, a lot of personal guys that are willing to take a haircut for quality. They know quality borrowers. We pencil as like the best borrowers possible. Everything is there from a lender's perspective, but Dime, Valley, all those guys, pens down. They don't want to touch anything.
Yeah.
The big boys, the JP Morgans of the world, what I'm seeing from my friend group is they are much more aggressive in the ESG space. Rent stabilized, New York City, Bronx properties, that all the paperwork pencils out. So the institutional deals seem to still be moving back and forth, and the rates are like 1% above the 5-year. So they're very low. It's still moderately low. It's like historically normal. But those properties have been compressing as well. I'm sorry, not compressing. They've been, they're becoming more available, and the property managers don't want to handle it anymore because of the stringent New York City laws. So they're letting go at much higher cap rates.
Can I ask one more question? Sorry. So what people have been saying also is valuation, because nothing's really been readily trading, is how do we really value? So what are you guys looking when you're underwriting a deal, how you're valuing with the lack of amount of trades out there in the market?
Yeah, we're pens down right now because of that, what you just said. We have the ability to be flexible and pivot. I think the future, for the foreseeable future in the smaller middle market real estate investment space is going to be owner users and friendly seller financing deals for people moving on. And there's an abundance of people like that. There's a lot of people that are going into their 60s, 70s, 80s that are moving to Florida or retiring and selling this $5 to $10 million asset that's been bankrolling them their whole lives, that don't have an institutional approach. But again, it's unless they're willing to hold paper and act as the lender, then the deals won't pencil.
And to add on to that, I think what we saw was that the key with the way that we, and Allon touched on this, the way that we take a lot of our debt and financing is primarily taking on fixed rate long-term financing from banks going in. So a lot of times you'll see, a lot of buyers like us that are, trying to position properties and sell them. They take short-term financing, maybe with a floating rate, so that way they have the flexibility to sell or refinance at any time they want. The people that bought those properties over the past 3 years, were at the time that they bought them 3 years ago, were underwriting to a refinance at 4.5%, 5%, which is no longer available. And so, kind of going off of a couple of points that Allon was making, one, that now means they have to sell because they can't refinance. So you're seeing a lot more supply coming to the market. But because the interest rates are so high now, it doesn't necessarily make sense to buy. For us, we were fortunate enough to take on 5-year fixed rate debt, from 2 years ago. So we're not in a position where we would have to refinance to, pay out investors and things like that. So that kind of touches on what Allon was mentioning about the flexibility. And so I think that, regarding underwriting and where we're seeing deals now, is as long as you're able to grow your income at your property, raising rents, whether it's office tenants and releasing, or, it's apartments and you're adding value to the exterior, renovating units, you're able to grow that income to a point where you're making a substantial cash flow margin, cash on cash, then, you're able to ride out whatever happens in the future, as long as you have that fixed rate debt. So I think that's kind of how we've looked at, our portfolio, and that kind of goes off of what Allon was saying about why we're pens down right now, is it's very tough to find deals, even with the abundant supply, that you're going to be able to grow the income to a point where you're, with this high interest rate market, to be able to pencil to a strong cash on cash return for 5 years.
To counter that, it's totally new to us, we've been put in front of a lot of accountants lately. I'm not even kidding, it's the craziest thing. And it has nothing to do with the properties themselves, like the performance of the properties. It's all driven by bonus depreciation. All of our investors all of a sudden could care less about cash flow and want to see bonus depreciation. So they're sitting us down with their CPAs, and they're all comparing cost segregation companies and saying, hey, what can we get here? What does this look like for us? So we have an influx of physicians out of nowhere. This just happened. We had one physician investor. He told 30 of his physician friends, and all these doctors now want to be in real estate, but all they care about is bonus depreciation.
Right.
Now go tell them to slow down when it's dwindling every year. They're freaking out, you know? And we try and tell them, like, you missed the cash flow wave. So you can't expect what we had over the last couple of years. But they're like, no, sit down with my accountant, and we're going to depreciate the shit out of this.
Yep. So fortunately, the investor appetite is still there because there are a lot of investors that need those depreciation benefits for their tax write-off. So the liquidity from the equity side is still there, and that's, I think, where we kind of see in the next 6 to 12 months. I think when we get back into this space, it's going to be largely without financing or seller financing, and with most of our equity capital instead, because these people want their bonus depreciation and different tax benefits.
Affordable, it's impossible. I mean, Long Island is so difficult. Like, I actually was so upset with Long Island politics. I'm like, how can it be that we can't get anything approved out on the island? And when we do, it takes 5 years. When in Arkansas and Houston, it's taking us 3 months to get shovels in the ground and build 100 units. And I looked into the statistics a bit, because the numbers don't lie. So says my accountant. Long Island has the lowest amount of new developments coming up across the entire country per person. So Long Island is like the most stringent housing laws in the country. New York City has stringent housing laws for rentals, right? But development is through the roof because they go through something called FAR, floor area ratio. It's a calculation, it's very basic. In Long Island, it's all land use, so they hold you up. I'll give you an example. I hate it, by the way. Just to answer that question, I hate it. It's horrible. Outside of the villages, Long Island's comprised of many villages, and they have their own mayors and their own people that run the show. Outside of those villages, the township should be punished. And the state has thought about it, right? The state has been trying to implement things into Long Island, like, guys, you got to ramp up new developments here. Who cares if it's affordable housing or not? Just get more houses, more units on the market. I'm building a 16-unit development in West Hampton Beach. Been working on this development for 4 years. 4 years! Talking about parking millions of dollars into this project. At the time, I was ranked the youngest developer in the country. Pretty cool title. I was excited. Talk about sucking the excitement out of somebody. Throughout this process, I was supposed to get stamped 9 times. Every time, the board changes their mind. It poses a huge challenge because now they pushed back and they said, hey, your designs are great, everything looks great, but we want 3 affordable units. And where does that come from? You know, what justifies that? It makes no sense, and I think Long Island needs a 180. There needs to be certain people that step in and push for developments. The villages that do push for developments have done absolutely phenomenal.
Awesome, yeah. Anything that maybe we haven't touched on that you feel like would be really riveting for us to know, or something that's, as accountants, that we can find valuable going into, our day-to-day lives with any clients that we have, or just anything that maybe we haven't touched on just yet?
Yeah, it's definitely all about the operator. Like a lot of clients I see probably a ton of you guys are sitting with your clients who want to invest in some sort of real estate when they're not operators themselves. I would just vet the operator over anything. The deals could be great, deals could be bad. Things go up and down. It's the market. We all know that. But it's all about the operators in this market. I have one investor. He sat me and another guy down with his accountants. One of the big guys in Long Island. I forgot the name. We're sitting down with them, and he's like, I'm allocating $1 million to each of them. And they're like, this kid is 24 years old. He's new to the market. He has a pretty interesting business model. But this guy's more sophisticated. He's been around longer. So we're pushing him. That guy, actually, it's funny enough, this is my biggest investor now, this guy, Taylor. He invested with us $15 million in equity. He invested with both of us $1 million each. He said, whoever makes it happen is going to get much more liquidity from me. This guy took his $1 million and ran away. He took his $1 million, allocated to a deal, not an escrow, and basically just evaporated. The deal died, and he just kept the $1 million. They're in litigation right now, and since we've done phenomenally well. But his accountant actually gave him bad advice. If it wasn't for his judgment, then he wouldn't be where we are today. We've made him over $20 million in 3 years. So he definitely loves us.
Sounds like a lot of professional skepticism, right? and just being
Yeah.
able to go back to the accounting terms as I study for BEC. Well, awesome. I mean, thank you again. I really do appreciate the time, and
Thanks.
we'll let you get back to your day, man. Thank you so much.
Awesome.
Appreciate it. Thank you.
Thank you, my friend.
Of course.
That was awesome.
Yes, thank you. Appreciate
Thanks,
it, guys. Thank
everyone.
you so much.